Good morning and happy Tuesday, everybody. Today is October 10th, 2023, and welcome to the worst bond market in history. Isn't that nice? We got that going for us this morning on this lovely rainy Tuesday. The worst bond bear market in the history of the United States. Going back nearly 250 years, it has never been so bad. From peak to trough, some 30-year US Treasuries are now down as much as 50%. The safe haven asset, U.S. government debt, down nearly 50% from its highs. That is because of what interest rates have done since the high, or I should say since the low in interest rates, the high in bond prices of mid-2020. Now, don't sit there and say, thanks for nothing, Fed, because it's not just the Federal Reserve that's creating this environment. I've mentioned this a couple of times right now. We've got this war going on between the U.S. Treasury and the central bank. The Fed's pulling one way, the Treasury's pulling the other way. The Fed is trying to slow inflation by raising interest rates, and the U.S. Treasury is trying to fake economic growth by spending as much money into the economy as possible. But of course, first they have to borrow it first. And both of these actions are putting stress on the bond market. They are sapping liquidity from the bond market, driving interest rates higher. And then we're stuck in the middle, just with like, hey, you guys figure your stuff out and then let us know. That has created the worst bond bear market in United States history. And meanwhile, the stock market barely in correction territory. You know what? Generative AI, Sam Altman said a thing, ChatGPT. Oh, there's a chatbot function on my search engine now. That's worth 500 points in the S&P 500. You sure about that? Are you sure, guys? Because something tells me when the bond market says A and the stock market says B, well, you figure out which one you want to listen to. My money's on the bond market. Every time. It's bigger and it's more important. But you know what? Whatever, Robinhood bros just pile into NVIDIA stock. I'm sure that's going to end very well. You know, I mean, the CEO wears a motorcycle jacket when he meets presidents. Maybe he's legit, right? Maybe that's not just a fancy version of Steve Jobs' black turtleneck. You know how Elizabeth Holmes tried to look like Steve Jobs, so she wore the fake black turtleneck too. I'm sure that has nothing to do with Jensen Huang's motorcycle jacket, right? No, of course not. Elsewhere going on this morning, remember that pipeline that I mentioned yesterday that, hey, there was this sudden pressure drop in the Finnish gas pipeline that connects Finland to Estonia. And I said, keep an eye on that story, guys. A sudden pressure drop that's eerily reminiscent of what happened to the Nord Stream pipeline last year. Well, we found out today that the Finnish investigators looking into that are assuming that it was sabotage. Emphasis of that word, assume. They have not found anything. They still haven't found the site of the leak, but they're carrying on with this investigation as if it was sabotage, which, of course, was my first reaction when I saw that story. Big, giant gas pipelines don't typically just have sudden pressure drops. That is, unless people blow them up or break them apart or cut big, giant holes in them because we all hate each other and we just kill each other for sport now, it seems. Sorry, guys. Sorry to interrupt the autopilot march into World War III, which, by the way, that situation is still going on in Israel this morning. No real developments other than people are still being killed over there. Keep an eye on what comes out of the Arab League. Israel has mustered forces all around Gaza. They're going in. It's going to be a bloodbath when they go in there. This is going to be house-to-house, door-to-door fighting. There will be civilian casualties. We have seen this before, but I don't know that we've seen this before on this scale because the death toll from this attack in Israel it's very high, guys. This is not your run-of-the-mill conflict in the Middle East. I mentioned that yesterday, and I just want to drive that home. This is going to be much worse. And the Arab League is getting together, and they're all saying, yeah, we want peace. Now that hundreds of people have been butchered, okay, yeah, now let's give peace a chance. Right before the Israelis get rolling, we know what the Israelis are going to do, and we know what the Arab League's most likely response to what the Israelis are most likely to do is probably going to be. They're going to use oil as a weapon, right? And that usually means if the U.S. is backing Israel, we have seen this before in 1973 with the Yom Kippur War. They will weaponize oil, they'll weaponize energy, and they will lump us in with Israel. So because of that, I initiated a long position in ERX yesterday. I took out some call options in ERX. That is a highly levered trade. Oil had made a pretty big move already by the time I made that trade yesterday, but it's still down considerably from where it was just a few days ago when that big gasoline inventory print came out. And I've seen a lot of data. I talked about it in my live stream on Friday that there's a lot of data out there that says that big gasoline inventory build from last week may have been an error, may not have been entirely correct, whether it was stupidity or nefarious, or maybe it could have been accurate, as there's that other possibility. I just don't buy that big gasoline drop from last week. That combined with the situation going on in the Middle East and the many prospects for escalation, I decided to make that trade yesterday. And with that, let's shrink my big melon of a head and see what's going on in markets. While we're shrinking my melon of a head, won't you please hit that like button, guys? It really helps this channel. It helps this stream to reach a wider audience. And of course, subscribe if you're new here. We do this every morning. Have your coffee with the melon heads every business day. The CNN Fear Greed Index is sitting at 30 this morning. That's deep in fear territory, but off its lows from last week. The S&P looks like it's just barely in green territory this morning, up about 5 points or 0.1% ahead of the opening bell. The Dow is doing a little better, up 74 points or 0.22% ahead of the opening bell. And the NASDAQ is pretty much unchanged, up 5 points, 0.04% higher for the tech-heavy NASDAQ. So stocks are kind of flat on the day, not a lot happening over there. Now let's talk about the dollar and bonds first. The DXY is a little bit lower again today, down another 14 basis points. That's below that 106 level. The dollar was due for a pullback. It's been rising pretty steadily since that Fed meeting in September. So I'm not terribly surprised to see a little bit of a pullback, and I'm also not terribly surprised to see that putting upward pressure on stocks. I think this big move we saw in stocks over the last couple of days since Friday and then on into yesterday, honestly, I think it was a technical pullback, a bounce off the 200-day moving average for the S&P 500, nothing more. There is no good news out there that explains this move in the stock market. It's certainly not being earnings driven, and I think we'll probably find that out later this week when the bank earnings start up. Again, that worst bond market in history we talked about. Where do banks put most of your money? That's right, into bonds. And if it's the worst bond market in history, that means the banks have lost an awful lot of your money. Looking over at the bond market again this morning, we got the 30-year Treasury is down 6 basis points at 4.88. The 10-year is reading a little funny today. The 10-year is showing it's up 5.5 basis points. But keep in mind, the 10-year was the only thing that moved yesterday. The U.S. bond market was closed for Columbus Day, but the 10-year was still trading in other places. So the fact that the 10-year is up 5 and change this morning, that's after being down 10 or 11 yesterday. So really the net move over the last 2 days in the 10-year Treasury has been roughly in line with what the 30-year has done, and down about 6 basis points. We've got the 2-year Treasuries at 4.98. That's down almost 10 basis points this morning. And the 1-month Treasury is still at 5.43, down about 1/10 of 1 point. We have seen the 1-month Treasury move up a couple of basis points in this last week here. It was pegged at about 5.38 for the longest time. That's telling me the market is beginning to price in a little bit of that November rate hike that could be coming in a few weeks here. Although CME Fed Watch Tool is still saying, I don't believe the Fed. And here is that main story, guys. The Treasury market sell-off has become the worst bond bear market of all time. That is according to Bank of America. And there's your cocaine bear picture there from that movie. I haven't seen that one, but it's on the bucket list. Treasury debt losses over the past 3 years have amounted to the worst bear market in nearly 250-year history of the United States. That's according to Bank of America's Michael Hartnett, who included some charts on Treasury performance in his latest flow show last week. According to one of these charts, Treasuries had lost nearly 25% on a total return basis to the market's peak in July of 2020 and Halloween of 2022, with the market essentially unchanged in the interim. Now, guys, that's a little bit of an old data point when he's saying the market is unchanged in the interim, because the 10-year Treasury has rocketed higher since since last year. I mean, here's October of 22. This is the high that they were talking about. So he's saying from this point here in the lows in 2020 to Halloween of last year was the worst run in U.S. bond market history. But look at what the 10-year did. Yeah, it came down, but we're well above that prior high now. So it's even worse than Mr. Hartnett over at Bank of America is saying here. The losses in the bond market have been staggering. And then remember, guys, this is where most of your money goes. Banks make loans, and when they don't make loans, they just buy bonds. Over the past week, yields on long-duration Treasury securities like the 10-year and the 30-year have touched their highest levels in more than 16 years. He says it's the greatest bond bear market of all time. That's according to Michael Hartnett, the Bank of America strategist who authored the note. He pointed out that losses on some 30-year bonds have topped 50%, as MarketWatch has reported. And check this out, guys. If you're sitting there saying thanks for nothing, Fed, it's not just the Federal Reserve that has done this. IMF says U.S. bond sell-off may reflect extra quantities on market. I love how they word this. This is the financial press. They'll never say anything that makes certain politicians look bad. The bond sell-off may reflect extra quantities on market. That's a really polite way of saying the idiots in Washington won't stop borrowing so much effing money, and that's why the bond market is a mess, and that's why our banks might be about to fail. No, they won't say that. They'll say it may reflect extra quantities on the market. It's the same thing. The International Monetary Fund is carefully watching global bond market developments after a recent U.S. sell-off, the fund's top economist said, adding that a tightening of financial conditions was among risks facing the global economy. IMF chief economist Pierre-Olivier Gourinchas, did I say that right? Gourinchas? He said that the sell-off of U.S. bonds could reflect a mismatch in supply rather than serious concerns about further hikes in interest rates or heightened concerns about long-term risks. That's important there, guys. He's saying it reflects a mismatch in supply. Too many bonds, too much debt. Not what the Fed is doing, not the rate hikes. It's the Treasury borrowing too much money. This is the IMF saying this. It might just reflect the fact that there is more of it, and so the price is adjusting. If you dump bonds on the market, the demand stays the same. The price of bonds goes lower. The price of bonds is inversely correlated to interest rates, and so it pushes interest rates higher. We're not seeing a huge decline in risk appetite in equity markets and credit markets, so it's a little odd. If you're looking at the U.S. Treasury market, maybe there's a question about who the buyers might be in the context where the government is also issuing quite a bit of that stuff. And again, the wording here is amazing. They will tiptoe and tap dance around the elephant in the room that the government just borrows too much damn money. They just won't say it. Why? Because these are all Keynesian modern monetary theorist a-holes who have to keep this globalist borrow everything you can and spend it into the economy to make it look like growth. No, God forbid we challenge the party line and say what is obviously happening. They're borrowing too much money. They're issuing too many bonds. They're crashing the price of the bonds, and that's driving the interest rates higher. No, maybe there's a question who the buyers might be, because everybody who would buy the stuff is selling it right now, where the government is also issuing quite a bit of the stuff. Yeah, they're borrowing money like drunken sailors. No offense, Mish, and you other drunken sailors out there. Gourinchas said the IMF was encouraging the U.S. to ease fiscal spending. Good luck with that, given that the economy was doing well, the COVID-19 pandemic has abated, and the country was not at war, at least not until next Thursday, apparently when World War III kicks off. In good times, that's a time to maybe reduce the deficit so that you can expand them when times are bad. Good luck with that. Reduce the deficit. What a concept. Thank you, Mr. Gourinchas, for saying what we're all thinking. The markets are asked to absorb a lot of debt out there. Maybe there's a little bit less appetite for that, you think? Not because there's more risk, but because there's just more quantity. They are just borrowing too much money. The IMF wasn't done with that. Check this one out. IMF warns of stubborn inflation and weaker global growth in 2024. Again, when they're issuing so much bond supply, when they're spending so much money into the economy to maintain the illusion of growth, that is inflationary. All right, so they're saying stubbornly high inflation and weaker growth in 2024. And then they're saying central banks should hold the line on monetary policy, and the outlook for economic expansion remains low on a historical basis. I want to scroll all the way down to here, the IMF. This is the same guy, Mr. Gourinchas again. He's saying monetary policy needs to remain tight in most places until inflation is durably coming down towards targets. We're not quite there. In other words, higher for longer. Central banks are going to keep turning the screws to us because the governments won't stop borrowing money to maintain the illusion of growth. That's making inflation worse. And the central banks can only hurt us to try to slow down inflation. Again, everything they do, it's just us caught in the middle trying to make ends meet. And looking over at the commodities board, I know we got into a lot of the stories first before we finished our trip through the market. December gold futures at $18.69 this morning. That's up $5. December silver futures at $21.94, up about 3 cents this morning, or 0.1%. We've got crude oils down about 44 cents at $85.94. That's down about 0.5%. And natural gas futures, keep an eye on those at 337. They're pretty much flat for the day. But the reason why I talk about those natty gas futures is check this one out. Finland gas pipe leak probe proceeds on premise of sabotage. Again, energy is now fair game in this World War III, not World War III, whatever it is going on right now in Europe and the Middle East and probably Asia soon enough. They're assuming that it was sabotage. The leak was detected in the Finland-Estonia pipeline on Sunday. Officials are expected to give more details today. A probe into a leak from an undersea gas pipeline between Finland and Estonia is proceeding on the assumption that it was a deliberate act of destruction. According to people familiar with the matter, there are no final conclusions, the people said. Officials are expected to give more details on the investigation later on Tuesday. European gas prices rose as much as 10%. So no hard evidence here. They're just saying they're assuming it was sabotage. Let's be honest, guys. It's pretty obvious what this was. We know it was, well, we don't know it was sabotage, but, with everything going on in that part of the world, is anybody surprised? And looking at the chart for natural gas here, we've got a couple of significant things going on. First of all, check out that golden cross right there. That is the 50-day moving average moving above the 200-day moving average. Major bullish technical indicator right there. We've had natural gas prices have rocketed higher these last few days from down around $2.80 up to about $3.50. That's pretty substantial move in natural gas futures. But I want to zoom out a little bit, guys, because look, this could go a whole heck of a lot further because these things were up around 10 just a couple of months ago in the summer of last year. Remember everything that was going on heading into the European winter last year, how we were so worried that Europe was going to run out of natural gas. Now, luckily, lucky, I guess, for us, Europe destroyed all of their industry last year. They shut everything down, especially in Germany. And then they had a very mild winter. So that energy Armageddon never really got here last winter. And so, of course, all those idiots from Just Stop Oil and the people blocking traffic and smashing gas pumps with hammers, they're just emboldened to say, see, we don't need fossil fuels. Yeah, pay attention to me. I hate my father, all that stuff that these stupid climate activists do to get attention in public. But they dodged a bullet last year in Europe. That's the main takeaway, guys. They really dodged a bullet. European energy policy has only gotten worse. Now we've got another pipeline is sabotaged. We could be looking at possibility of another oil embargo out of the Middle East. And look at how low natural gas prices are. Okay. I don't want to start sounding the alarm again. I mean, I was pretty alarmist last fall about what was going to happen in Europe, and it didn't happen, thankfully. But here we are, same point a year later, we dodged one bullet and we're acting like everything's going to be fine. Nothing has gotten any better. Things have only gotten worse when it comes to energy markets. And look at how much lower prices are here versus where they were just a year ago. Also, guys, looking at the oil markets, I just want to point out yesterday, we recaptured the 50-day moving average. This is West Texas Intermediate U.S. oil prices. Recaptured the 50-day moving average. Keep an eye on that level today. It looks like we're down a little bit here. The 50-day moving average is right around 85.30. Keep an eye on that one. Two more stories I want to cover real quick. China's Country Garden succumbs to debt crisis after sales plunge. Looks like Country Garden is bound for default. The property giant fails to repay a loan and warns that it is unlikely to pay off all of its international debt obligations. Chinese property giant Country Garden failed to make an international debt payment after its apartment sales plunged in September, succumbing to a liquidity crisis that worsened over the past few months. The 31-year-old developer said it wasn't able to repay a $60 million loan denominated in Hong Kong dollars that was due. Country Garden said it also doesn't expect to meet all its U.S. dollar bond and other offshore debt obligations when they come due or within grace periods. That last part there is important, or within grace periods, because that is effectively saying that they expect to default. And the company has hired financial advisors and plans to hold talks with its offshore creditors. Country Garden, guys, like Evergrande, they're dead. It's just a matter of time. They cannot possibly hope to repay their debts. So you're lucky to get pennies on the dollar if this company owes you money. This is just another one. And remember, guys, about a year ago when Evergrande was first starting to falter, everybody was saying, okay, it's bad, but at least Country Garden is okay. Look at Country Garden. They're a great example of a well-run company. Not so much, apparently. So the situation in China with the housing collapse that continues, it is not over. That is a debt pile that is not going to just go away because the government decides they're going to encourage banks to issue more credit. they're going to have to figure out a way to deal with this problem sooner or later. Meanwhile, the average Chinese person has all of their wealth tied up in real estate. It's not good. Not good. And last but not least, we're finally starting to see a little bit of reason when it comes to artificial intelligence. We got this one in CNBC this morning. Overhyped generative AI will get a cold shower in 2024, analysts predict. Gee, do you think AI might be just a little overhyped? Maybe just a little bit? I don't know. Maybe the whole NVIDIA CoreWeave thing, maybe that was maybe just a little too much hype. I don't know, guys. I just throw them out there. Finally, Ryan Brown over at CNBC, somebody is looking at this and saying, hey, guys, the worst bond market in history, higher for longer, China collapsing, companies going bankrupt. Maybe the fact that Google put a chatbot in their search engine is not going to be enough to save this economy. I just throw them out there. You guys do what you want with them. All right, guys, I want to say a thank you very much to Mr. Where are you there? Mr. Bean Counter. Thank you for counting your beans with us this morning. Bean Counter says Canva has delayed their payout to their paid creators by 3 weeks. They say it's because AI. Do you have any information on this? I do not. I haven't heard anything about this one. So, all right, that's in the homework. Bean Counter. Canva is delaying payout by 3 weeks because AI. That doesn't, my initial reaction, Bean Counter, I have no background on this one whatsoever. I don't understand how AI delays a payout. I don't get that. That does not pass the sniff test to me. Usually when people delay payouts, it's not because of artificial intelligence. It's because they don't have money and they're stalling for time. That's what it usually means. I can't say that for sure. I don't have any background on this one, but I'll look into that. And if there is a there, I will cover it on my stream tomorrow morning. Sorry, I don't have more for you. Canva delaying their payout to their paid creators. Thank you for bringing that one to my attention, Bean Counter. I will dig into that one and let you know. Appreciate the super chat and the support of the channel. And thank you to Mr. Steve Woitis, who says historically gold would drop in the face of many fast interest rate increases, but has held in. Can you explain this? So gold historically does do the opposite of what bond yields do. If you see bond yields going up, typically that means gold would go down because gold yields nothing. Gold is a safe haven asset. Bonds are typically considered safe haven assets. And so when interest rates rise, people tend to sell gold or not buy gold at least and move into bonds to get that yield. I suspect one of the reasons why gold is holding up pretty well right now, and Luke Groman had a pretty good tweet about this recently. I think I talked about this on Friday, because US Treasuries are starting to lose their appeal as safe haven assets because the United States government, because of the issuance of so many damn treasuries like I've been talking about today, it's losing their status as safe haven asset. Now, it hasn't lost it yet. It's just that narrative is starting to show a little bit of weakness because it is obvious to anybody paying attention that the U.S. government will be insolvent one day. It's obvious. And the only way the U.S. government will not be insolvent is through a massive monetary debasement that may or may not happen. And so I suspect what's going on now as the U.S. government runs $2.5 trillion deficits, even though there's no pandemic anymore and we're supposedly still not at war, they're starting to say maybe these safe haven assets aren't as safe haveny as we once thought they were. And so I suspect that is why gold is holding up so well despite this rise in interest rates, is because the safe haven being provided, go figure, 30-year treasuries down 50% since March of 2020. Maybe that's got people saying, I'm not going to go chase those yields on the long end of the yield curve. I'm going to stay in gold where I don't have my principal at risk. I suspect that might be why gold is holding up so well in the face of these rising rates. Let me know down in the comments, do you think it's something else? I know a lot of people are talking about the differential between Shanghai gold and London gold and that there's the flow of metal from west to east. And yeah, all that is happening. But I think this has more to do with the creditworthiness and the perceived risk in US Treasuries than anything else, Steve. And thank you, sir, for the super chat and the support of the channel. And thank you, Mr. Mike M, for the super sticker. Mike, your comment didn't come through, but let me see. Did you have another question? Nope, just being a swell guy. Thank you, Mike. I appreciate the super chat and the support of the channel. And it was a real pleasure meeting you in Vegas at the Silver Symposium, sir. It was always good talking to you. All right, guys, I want to say thank you so much for your time this morning, for having your coffee with us. Thank you to my Patreon supporters for everything you guys do for the channel. Link down below should you feel so inclined. There's still time, guys. World War III hasn't started yet. We don't have to do it. I don't know who's in charge, whoever you are, whoever's running things and making these decisions. I don't know who it is. Doesn't have to happen, guys. We don't have to kill each other by the millions. I just throw them out there. You do what you want with them. Hi, Mom. Hi, Dad. I love you guys. Till next time, live small and dream big.